We've seen a ton of changes in the auto industry over the last 3 to 5 years as Tesla has really taken over the electric vehicle space. A lot of the legacy companies have not made the transition to EVs in the way that they anticipated, in particular, Ford and General Motors moving a lot slower than I think a lot of us thought that they would. And then you have the harsh reality of the market as it is today. There appears to be a vast oversupply of electric vehicles, not only on the market today, but also coming to the market as a lot of these companies increase their production. And at the same time, very few companies are developing new internal combustion engine vehicles, which means that the people that want to buy ICE vehicles, which is most buyers today, are still fighting for the exact vehicle that they want. Margins are higher today in the ICE market than they are in the EV market. And I think that's going to continue. I've been talking about this for over a year on this channel now, that there's a lot of pressure coming to the electric vehicle market. I talked in December 2022 about the fact that Tesla had started cutting prices for their vehicles. That happened all throughout 2023, and we've seen more price cuts this year, specifically in Germany and in China. If you're interested in the auto market today, the best buys in the auto market are not in the electric vehicle space. It's not Tesla, it's not Rivian, it's old school companies like General Motors, Ford, and Stellantis. So I'm going to go through their numbers today and how they compare to a big company like Tesla. It's a little bit harder to compare them to some of the upstart companies like Rivian and Lucid who are still losing money. It's not clear if they will ever get to the point where they can be profitable. But Tesla is a very mature automaker now. And so we can actually compare their numbers. And I don't think the trends are very good for investors. So stay tuned for my full thoughts. My name's Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Now let's start with a couple of charts to just lay the groundwork of where we are in the auto industry today. Now I'm going to start with automotive gross margins because I think this is really the tip of the iceberg of where pricing power is in the market. You can see that the bottom two companies here are General Motors and Ford. There are a few reasons that they have lower margins, specifically than Tesla. One is that they don't own the dealer network, so they're not taking as much margin out of each sale. They also just generally have more revenue, so more vehicles going through the system. So not all that surprising that as you get to a bigger scale, you're going to have a little bit lower margins. Stellantis is still maintaining a pretty high margin. We'll see where that ends up for the second half of 2023. But look at Tesla with the blue line. And what you see over the last few years is that Tesla's margins went up during the pandemic, specifically in the end of 2021 and early in 2022. And the reason the margins went up is Tesla was raising prices at that period of time. You might remember that vehicles were very undersupplied, and the one company that was increasing their supply at that time was Tesla. So if you're looking for a new vehicle and your options are a Tesla or something you're going to have to wait 6 to 12 months to get, well, a Tesla looks a little bit more attractive. You're willing to pay a little bit higher price. Prices were crazy back then. And so Tesla raised prices. That's why their margins got up to 27%. But what's happened since then? Well, they've kept increasing their production, but prices have dropped dramatically, now down to 19.8%. I'm going to get to operating margins in just a second. But the reason is that they've been lowering prices, and they've been lowering prices because demand wasn't there at that higher price point. The auto business is all about supply and demand. There are very popular videos here on YouTube that talk about how General Motors or Ford are in trouble because they're shutting down their plant for 2 weeks. What they're doing is they're managing inventory. They're managing the supply of vehicles that they have in the market. That's exactly what you want to do if you're a manufacturer. The goal as an auto company is not to sell the most vehicles possible, no matter the price. The goal is to make the most profit. So if that means cutting production back by 100,000 units a year, that's what you do. Tesla is running a little bit different business. They have a different mission. They have a different leader. They've prioritized growth in volume at all cost, at least until now. Now, in the last couple of conference calls, Elon Musk has really backed off on the fact that they're going to grow 50% a year. That was never a reasonable goal, but it was Elon Musk who put that out. He's the one that said that they were going to grow volumes 50% a year. He's the one that said that they could do it for the foreseeable future. Even though if you just simply did the math, there was no way that they could do that for over a decade because they would be selling more vehicles than were sold in the entire world. So now we have delays at the Mexico plant, we have shutdowns in China, we have shutdowns in Germany, and it appears that Tesla, like other automakers, is starting to manage the supply that's going into the market. So these margins might stabilize, but it also means that revenue growth is going to slow down. So if we go to the operating margins, this is where things get a little bit more interesting from a comparison standpoint. And that's because now you see that Tesla has a lot of operating costs compared to some of their bigger rivals. So Stellantis actually has a better operating margin than Tesla does. And Tesla is starting to get pretty close to General Motors and Ford. A drop from a 16.8% margin to an 11.2% margin last quarter. And then if you pull out some of those one-time things like the EV credits that they get, the margin goes lower pretty quickly. So this is not a company that has some sort of sustainable higher margins that will always be in effect. In fact, we have seen over the last couple of years that Tesla lives the same supply and demand game that every single other automaker does. But the thing to focus on here is the trend. Do you want to be the company that is lowering prices just to move metal and their operating margins are dropping like a rock? That's the position that Tesla's in. And this is really pertinent when we get to valuation. That will be a little bit later on. But just keep this trend in mind for gross margins and operating margins. The final chart that I want to show in here is free cash flow. And I pulled this from the third quarter of 2022. The reason for that is that's really when we saw the best cash flows from Tesla. They had this combination of both high margins and they were increasing their scale, their number of deliveries. But what happens when you lower your prices and you lower margins? Well, that free cash flow evaporates really quickly. You can see that in the blue column, Tesla's free cash flow has gone from $8.9 billion in a quarter to 3.7 in the most recent quarter. Now, we'll probably see that come down again in the fourth quarter. And if these trends continue, it's very possible that the company gets to break even. What is interesting is when you look at the other three companies. General Motors, very consistent cash flow. It ebbs and flows quarter to quarter, but that cash flow is actually increasing over time. Despite the fact that Tesla is growing, General Motors stock is going nowhere, their cash flow is going up $12.3 billion over the last 12 months. This is why I think this is the best auto stock right now. General Motors is performing extremely well. They make phenomenal margins on trucks and SUVs, and now they're starting to buy back stock. Another interesting one is Stellantis. I think we've seen more discounting from them recently, so I'm really interested to see where margins and free cash flow goes in the second half of the year and then into 2024. And then Ford, I think, is kind of the laggard of these three, just not the same from an operating perspective. The brand doesn't seem to be as strong as General Motors or some of the Stellantis brands like Jeep. But again, we do have positive free cash flow from Ford. So just looking at those trends, I think you could take this a number of different ways. If you are an electric vehicle investor, you could say, yep, Tesla is still very profitable. They're making strong free cash flow, and this is the future of the industry. So why wouldn't you want to own that stock? I'm going to get to that in the second half, but I think the troubling things for Tesla is they continue to increase supply and they're having to lower prices. And this is at the same time as more competition is coming into the market. So I don't see any way in the future they're not going to have to continue competing on price. That means lower margins, both from a gross perspective and an operating perspective, and worse free cash flow. On top of that, the multiple, the price to earnings multiple, price to sales multiple, however you want to look at it, for Tesla is about 10 times higher than it is for some of these legacy automakers. So yes, electric vehicles may be the future, but investors are paying an insane premium to get to that future. And that's, I think, fundamentally going to be the biggest downfall for Tesla, is that it's just priced to perfection. And this is in no way a company that has been operating to perfection for the last 12 to 18 months. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. I'll pull up some of these multiples here, but this really shows exactly how expensive specifically Tesla is. If you can look at the price to earnings multiple, these other companies almost don't show up on this chart, but I'll give you the numbers right now. Ford's price to earnings multiple, 7.2. GM's multiple, 4.9. That's before buying back 15 to 20% of their stock, which they did at the end of the fourth quarter. So we'll see that adjustment when they do their next quarterly report. And then Stellantis, 3.1. Tesla's price to earnings multiple right now is 68. Price to sales multiple, you get the same story. Tesla has a price to sales multiple that's more like a tech company, about 7, and on the other companies are hovering right around 0.3. So the question that investors have to ask themselves is, what does the future of the auto industry look like, and where do I want to put money based on these valuations? Because I think these two things interacting is really what's important. And right now, I think what we're seeing is more investment is going in the electric vehicle space, but more and more companies are losing money. There's this supply and demand imbalance. That means that for the foreseeable future, there's going to be basically a price war that's going to cause a number of companies to likely go bankrupt, have to go through some sort of restructuring, maybe even get acquired by one of their competitors. The analogy that I have here is the solar industry. The solar industry went through this between 2010 and 2015. Ton of growth in the industry overall, but there was simply too much supply. So companies started to have to compete on price. When you're a manufacturing business, you have to keep churning out profit to keep that capital investment that you've made over the years work for you. So the only option for a lot of these companies was just to lower their prices, and they lowered them so far that eventually they weren't able to invest in the next development, the next product, and they fell behind and eventually started losing so much money that they weren't sustainable anymore. I think that's ultimately going to happen to a lot of these companies. The Model 3, even the Model Y, looks effectively the same as a vehicle that's almost 10 years old, the original Model S. So there's a lot of challenges here for Tesla, and so there's a lot of challenges here for the electric vehicle industry in general and Tesla specifically. You could add in the fact that FSD is not performing in any way the way that Elon Musk and Tesla has been promising for over 7 years now. They're saying that people would be able to drive themselves around and say that Teslas are going to be appreciating asset instead of a depreciating asset. That's absolutely not going to be the case. The robo-taxi doesn't seem to be anywhere near reality, and artificial intelligence even seems to be something that's more promises than there is execution. So what are investors paying a premium for? They're paying a premium for an automaker that's having to compete more based on price and is potentially in a segment of the market that's going to be oversupplied for many, many years to come. Then you look at some of the legacy automakers, General Motors, Ford, Stellantis. Nobody's coming in with a new internal combustion engine truck or a new SUV that fits 7 or 8 passengers. But that's where all of the money is being made. That's where the profits are for these companies. And I don't see that ending anytime soon. This may be my view of the world. I live in the Midwest. I do not live in California, where electric vehicles are somewhere around half of the sales of new vehicles. Electric vehicles here are under 5% of new vehicles sold. And guess what? That's the case in most of the US and most of the world today. If you see everyone driving an electric vehicle, then that's an outlier. That is not the reality for most of the market. And these places that have not gone all in on electric vehicles yet, I think are going to take much, much longer to get there than a lot of people think. It's not going to be 2030. It's going to be more like 2040 or 2050. Yes, decades in the future before most people are driving electric vehicles. It is going to take that long to change the infrastructure, change habits, get the price points down. And that means that in the meantime, General Motors, Ford, and Stellantis are going to be churning out cash that they can return to shareholders with dividends, buybacks. GM is the one that I think is the top stock here. They announced a massive buyback late in 2023, going to buy back about 20% of their stock. And if this cash flow continues, they could do that almost on a yearly basis. So given the valuation, given the trends in the market, given those margin trends, I think where investors want to be right now is in companies like General Motors and Stellantis, not in stocks like Tesla, which have a long way to fall if they don't execute absolutely flawlessly. Now, what do you think? Do you disagree? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.